So, and we are live. How's everybody doing? So, this is Major Investor. Thanks for coming. Thanks for stopping by, and really appreciate everybody that oversees all the information that's provided for and to you free of charge. So, all the information that you get and collect here is all free. So, without further ado, we'll get right into the news. Okay, so Um, for all those that have listened to my past videos on real estate investing is your only avenue that gives you some sort of guarantee that you're going to make money on your money. And the reason why you do that is through dividends. They pay you just for holding the stock. So, like everybody else who wants to make money, you want to buy into a real estate fund or a real estate company, better off using a platform. It's Wealth Simple. I highly recommend it. Um, Friends of mine who are using it right now, they say that there's zero commissions, zero. Um, the only thing they don't get is the research and fundamentals on stocks that you want to look at, and the um, buy ratios, sell ratios, and there's no analyst fundamentally watching any of it for you for your portfolio. But zero commission is zero commission, guys. There's zero commission, so it costs you nothing to join, costs you nothing to get in and get out. The only thing it's going to cost you is if you want certain things. Remember that everything's on a 15-minute delay. They have real-time quotes, but real-time quotes cost money. You want tier to look at your different tiers to find out who's buying it and how much they're buying it for. That's again, that's going to be a different cost associated with Wealthsimple, but it's going to be probably smaller than what you're used to paying for it on a different platform. Um, Even though the platform have certain regulations and rules, each of them have their own, um, and you have to look at your market capital and market strategy for all of them. Okay, so let's get into something else, shall we? Because I've been talking about real estate investing for better part of 4 or 5 months now. I haven't had too many followers follow me on it. Um, uh, yeah, there's yeah. Without further ado, on what you want. Okay, so the information that I provide you with is like a data collection of all the dividend stocks, and then I broke down all the dividend stocks into a few very minor companies that I feel are in your best interest. Um, and the reason why that is because I talked about LIF the other day, LIF, and their quarterly dividend. They pay $4.60 a share compared to the Royal Bank, which pays $4.80 a share. The difference is the Royal Bank's $193, I believe, $194, and they provide you with the $4.80 per year. They pay a monthly dividend, so it gives you a huge spread. Okay, Lyft is going to cost you $47 because right now iron ore is taking a hit. If you haven't been paying attention to the iron market, when you buy something, you have to keep your information that you collected very integrated, so that you can keep track of what's going on in the marketplace, so you can better position yourself for those. So um, let's get sidetracked from that. The real estate part of it. If you want more information on real estate, watch my previous videos, and I talk in depthly about it. And uh, the reason why we got invested in those stocks in the first place is because they provided us a dividend. They still provide us a dividend. And if you haven't been watching, BTB has actually hit $4.33 this morning and continually going up. I suspect it's going to go all the way to 580. It'll probably get surpass that amount. Their dividend is about to get unleashed from 30 cents a year to probably around 55 cents to 50 cents per per annually. So you break it down, that's 4 cents from $2 from 2 cent, 2.5 cents per share to 4 cents. So that's huge, right? For monthly dividend. If you look at B2O, they offer you 4 cents or 16 cents, 16 cents, guys, every quarter, right? 16 cents divided by 4 or 20 cents divided by 4 is 4 cents every quarter. So you're getting it right now at $4 and you're getting paid every month. So if you look at it that way, you're making big money. BT, I talked about, I'm going to talk about H&R real estate, and they pay good dividends and they make, but they're a little bit more risky. So they go up and down. They're a bit more risky. Their investments are businesses and the longevity of it and versus shortevity of it. So the reason why they're a bit more risky, they take on more risk themselves. So they'll buy the high rises and they'll rent them out to organizations. But if there's no one to fulfill those lease, like if you look at Calgary, like where I'm at, probably in Calgary, and I'm invested through H&R. Right now, they're not doing that great because 25 or 70% of those businesses are gone from Calgary. So who's leasing out those places? Nobody. They keep dropping their price. Nobody's leasing it out. Okay. So why is it important for you to pay attention to what the market capitalization is? It's very important because that's where the money is made and lost. So if they can't pay their dividend, it goes into a negative fund, and then they have to go and borrow against that to pay your dividend. That's a bad investment. Okay, from a bad and remember that these are short-term, long-term holds on your money. So if they're not making you money, why are you holding them? Because they're not an investment animal that can generate multiple levels of income throughout their existence, right? So like Nortel, or like Nortel's a bad example because it went under, but Nortel, it took off and it took off like a bat. These stocks don't do that. So if it doesn't make money, it doesn't make sense to hold into them. So you have to have, that's what we say the exit strategy. Anyway, I didn't want to get into that. I wanted to get into me, you, and the picket fence and what makes you tick. Me, it's money. Because, well, people like wealth. How to make money make me money? How do I get my money to make me money? So my one trick pony is real estate. Okay, I was going to go into talking about um, investing. So when you invest in yourself, you go and get educated. You become better educated than you are right now. You look for a job that's going to be more fitted to your educational purposes, so that you can target vast areas of what you want to do in your life and your struggles. And so if you went to university, college, and all these things, you invest in yourself. That's investing in yourself. That costs money. Everything that you do costs money. Everybody wants your money or your parents' money or their money, right? And if you look on the internet and you look at on YouTube, you see all these ads for how to make money, how to generate income, how to start your funnel cloud, how to go on and get your email list so that you can do your affiliate networking. And there's nothing wrong with it. But the problem is that where at the bottom line are you making money? Click banks, like I, I'm in click banks. I like click banks. Only problem is with click banks is it's all about selling you something to make them money, not you money. It's all about, oh, you take this course, you make this much money. You do this, you make this much money. See what everybody's trying to do? Get your money. So isn't that funny, right? Everybody's out. Oh, hey, hold on a second. You can make them $3,000 a day. $5,000 a day, but you need to take my course. And then when you get into the course, oh, you got to take another course. Oh, you got to take another course. In order to be guaranteed now to get the money that you already invested in yourself, now you have to pay even more money to get a better course. And at the end of it, you're out all this money and you're generating 200 or 300 bucks. That's not even covering, if you went and took a loan out, wouldn't even cover the loan, right? Because you're looking at, that's the problem. Everybody wants to become an institution, but no one has any education to back it up with. So it's all on their own. Oh, I made money this month. I'll now make a course so I can make even more money for people to generate more and more income so that I don't have to work as hard. And if those initiation of that investment starts to fail on me, I still have this other revenue coming in from everybody else that bought into my course that is so great. But when you look at the course load, you're going, what did I do? How do I get out of it now? I'm in a mess. I've already spent $800 on Rich Dad, Poor Dad, and I've already done the investment strategies that they offered, and I'm still not understanding the whole concept of buying and selling real estate for other people, multimillionaires. You think multimillionaires need your help selling and buying and selling property? The only thing they're interested in is trying to get your money. Like, everybody wants your money. Instead of, and I don't want your money. I want you to think of it, if we invested together, okay? If we built an investment strategy together, who benefits? Who would benefit? Everybody. The whole collection benefits from it. So if I'm trying to target a couple companies or company or organization and try and put you all together and form an alliance or guru session on how to invest and where to invest in, then we would become wealthier together, right? Makes sense, right? But what happens is this is they ask you to go into it and then everybody goes into it. I'm the one that got in first. So guess who's out first? Me. I'm out first, right? Not you, because I'm telling you that it's worth $14 and I'm out at 9. And you guys are all holding the bag when it goes to 7. Does that make sense to everybody? That right there, it tells you you're a liar and I'm not investing through you anymore. But the truth of the matter is, when did you get in? You got in at $5. You're still making money at 7, but you didn't put your stop limits in, so you're not protected. So that's not my fault, right? I I'm trying to get you all organized under one avenue, but I don't want to do that to you. I'm just telling you the best strategy out there so that you understand what the strategy imposes so that you can make the best decision for yourselves. It doesn't mean that I'm perfect. I'm not perfect. I'm not trying to tell you that I can time the market just like that, like those guys that you see on there trying to sell you something that you probably don't want any part of because it's probably not making any money. But the idea of selling you a course is making them money, of course. So the more courses that they have to provide for you, the better it is for them. So that not the better it is for you. So that's why it's funny and that's why it's hysterical because while I'm throwing the ball, someone else is hitting it somewhere else, if that makes any sense to you at all. We're not playing the same ball game because normally if you're batting it, someone else has got to catch it. But before they catch it, I'm batting another ball out. That's the whole point. Or someone else is batting another ball out. And the whole idea of everybody getting together and buying a set of stocks, good fundamental stocks, is awesome. It and this is going on right now too. I, I've talked to a different bunch of gurus and I've talked to a bunch of people, and that's what they try and do. They try and go on a marketplace and sell a company that they are very interested in. And the more people who like it, the more chances that they have to get in and look at it explode a little bit, 30%, 40%, and then get out. I'm not like that. Okay. That's the reason why I get in real estate because the dividends are what pays you money and you want that residual income when you retire. Everybody should be thinking about retiring. How do I get out of the rat race? Every single person should be thinking, how do I get out of the rat race? They're not going to pay you any more money. They're not going to give you any more money. So how do I make what I make it work for me? The only thing that makes any sense is real estate. And that's the bottom line. When you invest in real estate is the only thing that's going to make and generate you money. Now, I posted on my bottom of my link, and I strongly suggested you guys uh, subscribe me and add me, because there's nothing I can do for you if you don't like and come and join me in a session, so that we can start talking about you and what you want, what your needs are, and do you think this is a good investment or not? Someone came on and said that they're investing in car washes. It makes the money right now, and I'm like, before you invested in a car wash, did you do any due diligence? Did you find out how many car washes were in the area? Did you find out why they were selling it? Are they retiring? Are they old? They just don't want to do it anymore? Is it cost too ineffective? All these things that you do on a daily basis that generate income, you have to ask yourself, okay, what are the costs? What do I need to do to make money? How much is it going to cost me to set it up? How much are the repairs? And then when are the repairs? And that's the thing where everybody gets sidetracked on. Oh, this is how much money you make every month. But there's expenses. Yeah, but they're write-offs. There's still expenses. And if your write-offs exceed the amount of income you have, that's that goodwill. That means you made nothing, which means your write-offs is 16% instead of 100, because you don't have enough money that you've made to write it off. So then 1 year carries over into the next and the next and the next. So if you're investing in a company that doesn't make any money, why would you invest in it? You wouldn't. So if you're investing in yourself and you're not making any money, think of it like if someone was investing in you and you're not making any money. It doesn't make sense to keep on investing in it. So when you're gung ho, ready to sit down and come up with a strategy and a plan of action, what you want to do, you have to think about your fundamentals and you have to think about your percentages and how much you want to make on it. And this is why I didn't want to get into real estate today, is because I already got 5 or 6 videos on real estate investing. I've already come out with my targeting, and the reason why I picked those stocks was because they give you more bang for your buck. So yeah, like H&R, DIR, OXSQ, they give you dividend stocks. They pay monthly, um, and they provide you with a better rate of return uh, per dividend that they offer. But what they don't offer you is the amount of shares you can buy. So the amount of shares you buy offsets the differences. I hope you understand that. So DIR gives you 70 cents on the dollar every year. So if you did the math on it, it's going to give you over 12 cents. No, it's going to give you what, 6 cents? 6 cents a month. But you're not getting 6 times the money, is what I'm getting, right? You buy BTB, it's 2.5 cents, but you're able to buy 5 times more shares, or 6 times more shares, or 4 times more shares. So 4 times 2.5 cents. So that's going to give you 10 cents a month. They're giving you 6 to 7 cents a month. You do the math, right? You're making more. You're able to get more shares. You're making more money than they're offering you at 16. Same thing at 20. They're offering you $1.20. You do the math on it. Oh, that works up to 10 cents. I'm making that now. And I got 5 times more shares than you at $20. So obviously, I'm going to stick with what I know. How much money do I need to make? This is the one I want to make with. This is the company I want to make it with, because I'm going to get more money on my return every month. And now that now that they've gone from 32 cents a share to 58 cents a share, the dividend is going to follow. You understand what I'm saying? Dividend's going to follow. So they're giving you 30 cents and they're only making 32 cents. That's 98% return on capital. Holy crap, that's huge. So, it could be 54 cents they offer you. That's huge, right? 54 cents a year. Divide that by 12. There you go. There's your estimated rate of return. So, if you're looking at all that, okay. Hold on 2 seconds. Bear with me. I'm going to check something out for you guys. Yeah, 4.5 cents a share. Okay, so let's do the 0.70, 70 cents, because that's what Dream Realty Real Estate's giving you. Trust. Okay, they're doing the exact same thing. Okay, so we'll do the right now. There's only 0.30, 30 cents a month. Okay, so 70 cents is going to give you almost 6 cents. Almost 6 cents. 5.88, 5.833 per month if you went with Dream Realty. Okay, that's no joke. It's almost 3 times. But where's BTB trading at? $4. Where's DIR trading at? 16.78. Okay, so how many shares can you buy of direct of the and yes, it's more secure if you look at it, but all real estate stocks are secure as long as they're making money. So if they're making money, they're making you money. So if that's the case, then that's why I want to get away from the real estate view of it. This week was to try and inform you of your money, how it makes you money. So right now, if you're into BTB, yeah, it's awesome. If you're into direct, that's good. If you're in H&R, that's good. Anything that makes you money, every money, I'm going to be thumbs up, my friends. You can pick a, I can tell you all the ones right now. Tell you certain ones anyway. Hold on, 2 seconds. I had it up here. Here we go. So we're going down the list. We got BlackRock, TCP Capital Corporation, TCPC on the NASDAQ. They pay a quarterly dividend. When I was looking at them, they were at $13.24. They pay $1.20 per year. Okay, that's pretty good. That's not bad. So you divide that by your 12 months, right? Remember, they pay quarterly, so you got to remember that too. So you get paid 4 times a year. So it's $1.20 divided by 4. $0.30 on the dollar. You understand what I said by offset? So 30 cents is a hell of a lot more than 4 cents, right? and that's even 5 cents. It's still 6 times more. So when you do your offset, you buy it just before they pay their dividend, so you can capitalize on the dividend of 30 cents, because that's huge, and they're only trading at $14 a share. That tells you right there that this is a high buy opportunity. Um, but you want to go back and forth because you want to get paid that monthly income. If you're to buy, and that's why I want you to look at the other videos, so you can check them out, because it tells you right there about the differences in valuations. Um, and this video or this live stream is about telling you how to make the money on your investment strategy. So offsetting means you're buying the biggest bang for your buck. So I want to sell my BTB and I want to buy BlackRock Capital, but they trade on the Nasdaq, so I have to keep track of the U.S. currency. And if I'm buying U.S., I want to stay in all U.S. So then it's going to be Oxford and BlackRock. And those are my two stocks I'm going to buy and sell. I suggested buying Ciro. Ciro is only just recently done a share buyback plan, SSSS on the Nasdaq. I recommended them before because last year they paid $8 per dividends for the whole year. That's huge, considering that they're only like $15. Now they're $8 and $8 and some odd cents. Here, I'll give you the exact quote. So, yeah, they're only $8 and a few pennies when they offered their share buybacks. So that was yesterday. They on Tuesday they offered, at the end of closing on Tuesday, they offered the buyback. That they're doing the buyback. They're going to spend $15 million on that buyback. Yeah, $8.90. They're up 12 cents today. So when they do a share buyback, companies can buy at the end of the day or at the beginning of the day, depending on how they feel their stock price is undervalued or underrated. Certain stocks that I've recommend them do a share buyback, all they done was they increased the amount that they're buying back at a lower price and trying to push. And it doesn't matter how they do it, but they didn't make an announcement saying they're buying back their shares, although that's exactly what happened with this company. They did a share buyback plan, and what they're doing is they're buying throughout the day. So instead of buying at the beginning or the end of the day, like most companies do, they're buying it in between on the low end. They're trying to regain all their shares that people are trying to day trade on a daily basis. Don't exactly agree with it. The only reason why is you start buying back your own shares. It doesn't matter when you start buying back your own shares. You're just trying to lower the value that you're buying them back at. That's what this company's trying to do. They're trying to buy back their shares at a lower end to undercut the people that are trying to sell it. I get it, but it doesn't always work to that strategy. And because what happens is people start realizing when there's 100,000 to 200,000 shares trying to buy it back at a lower price, they see that. As soon as it goes to that price, all of a sudden there's a million shares that want to buy it. They already know what's going on, and they make provisions on it so that they boost the stock price a bit. It the way you should do it for share buybacks, for those companies that are listening, you want to do a share buyback, this is how you do it. You do it at the beginning of the day or the end of the day. And at the end of the day, if your stock takes a hit on the end of the day, that's when you want to start your share buybacks. So it works in opposite of a stop limit loss when you do a share buyback. So you want to know when it's going to be at the lowest point of the day. Usually it's at the beginning or the end of the day. So if you're noticing that people are buying it at the beginning of the day, that's not where you want to buy it. You want to buy it at the end of the day when people are selling it. So you're going to go 2 or 3 cents below where the market is currently trading it. And then at the beginning of the day, there's nothing, right? Zero. It can go right down 12, 20%. You don't care because at the end of the day, when they're selling it, you want to be buying it. So that's when you want to start your ratios. If it's the opposite, if people are selling it at the beginning of the day, that's when you want to start your buy-in. When you do your analysis on your trend lines, because you're the owner, you have an advantage over everyone else. And that's the bottom line. So Zero Capital right now, I recommended it 4 months ago, is trading at $8 and some odd cents. They lowered their dividend, they lowered their yield, they lowered the amount of money that they're making. So it was a not great investment. Okay. But it's a SPAC play. So you have to put your stop limits in. I put my stop limits in. I bought it at 15.26. I put my stop limit at $15. I got covered the exact same day. Didn't take much of a hit on it. 26 cents is a lot for me. So, like, I have to understand that, right? So, I could have bought back when it went to 12 because it was looking like it's hovering around that $12 range, but it never went above its 50-day moving average. So therefore, I stay away from it, and it continued to slide. And now it's at $8 and some odd cents. I recommended someone buy it at $11. They bought it. I asked them, did they put their stop limits in? They said no. I phoned them up and I said they're offering 11 cents a share, which is horrible for the quarter. So, um, and they haven't made as much money. But again, they were into SPAC plays. Now they're trying to get out of the SPAC plays and go into energy and EV. But as you all understand, EV's taking a hit. Nickel has gone through the roof. It was over 100,000 only on a speculation play, or not speculation play, but a short play that someone couldn't cover. A billionaire couldn't cover the because everybody's trying to, like I said before, everybody's trying to buy into it. Nobody wants to sell it because everybody wants EV. Like it's the next biggest thing. EV, EV, EV. So everybody's going electric. Doesn't matter who you are, they all want to go electric. Problem is with going electric, we already talked about the infrastructure just does not support it. So unless you believe natural gas is going to 14, 20, $24 per, and if you think that's going to happen, people just can't afford it. Then it's going right to the biblical sense where uh, for every dollar that you make, it goes strictly into just living. Okay. So if you believe that we're headed that way on the biblical sense, like in the Bible, when it talks about the end of days, talks about people living from paycheck to paycheck. No, 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 no. Not paycheck to paycheck, survival from paycheck to paycheck. The amount of money that you make just goes into your food, water, and provisions. That is it. So if you think we're going that avenue, then you are right in line with not investing a single penny. Instead, you're going to be looking at how do I obtain my holdings and not spend anything just to survive. Because when you're just surviving, there's no airplanes, there's no uh, restaurants, there's no extras, there's no Shaw cable, there's no internet because you just surviving. Okay, so when you get to that point, there's no news, there's no outlets for you to. There's no generation how you're going to generate more income because there's just no data stream for it. So then your whole life then becomes a slave to the system to provide you with the foods and essentials that you need to survive. And that's what they call it the biblical sense. That every dollar earned for every dollar of wages is what it's going to cost you for a dollar of food and water at your table. So just so that you know, and we're not there yet, but the inflation keeps going up, and wages don't keep going up. We're going to get there really fast, right? I think the world wants to deter us and go that way, only so that they would have it out, saying that everybody's in the same boat and that we all have to start at zero, so that our dollar valuations would have to start at zero, because it's easier to do that than to actually come up with a plan on how to pay it off. Um, and that's the whole trick, one trick pony to everything and everything that you invest in. So was Suro a good recommendation? No. Was it a recommendation that was based on facts? Absolutely. From last year to this year, their fundamentals were high. So Suro was a really bad investment. If you invested in Oxford, you didn't get anywhere. Last 4 months, it's still at $4. The only thing is that you would have gotten the 4 cents per share dividend that they offer you, or 3 cents, 3.5 cents per share, which is 1 cent more than BTB. And my recommendation was, if you live in the States, you're in Oxford. If you live in Canada, you're invested in BTB. And because our dollar is so low that it makes up for the 1 cent that the U.S. Now, not to get sidetracked or anything, but when you look at, hold on 2 seconds, guys. Sorry about that. Just gonna look at something. Okay. Just trying to check out the delay. Still got a delay on this thing. Don't know what the hell's going on. But anyway, without talking too much, so yeah, Oxford's trading at $4. BTB right now, if I can get your real-time quote, is trading at $4.28. Between 428 and 429, we have a bunch of asks. Okay, the bidders are the people buying. The askers are the ones that want to sell it. So we have the buyers at 428, and we have the askers at $4.29. And how many shares? 8,200 shares trying to buy it at 428, and the sellers trying to sell it for 429. Okay, so that's a real-time quote, and that's right now at 10:59 a.m. in the morning. I've been on live for 37 minutes and 22 seconds. Thanks, DJ. Big hands up. Thanks for stopping by. I'll add you as a moderator. If you have your own channel, that will be huge for you. Yeah, the markets are up, so that's awesome. Anytime the markets are up, that's a good sign. Things are going good. Yeah, I'm sorry for delay. You're hearing my voice, but nothing's coming out for like 20 seconds. Still trying to figure out why that is. Tried doing different things on YouTube to find out why there's a delay. I'm guessing it's probably because they don't want me to say anything derogatory, negative, promising a whole bunch of stuff I can't possibly promise you. So right now, if anyone's interested, Sun real estate investment is up 9 cents to 9 cents today. If anyone's interested, and the symbol is SRES. They're trading at 9 cents. 100,000 shares trading hands. If you look at the market capitalization on it, that's pretty substantial. If you're interested, there's other stocks too. I talked about. Oh, wait, BBDC on the New York Stock Exchange. Earnings per share is 147 now. If you look at Oxford and you look at Baring, they're pretty much in the same ballpark, but one's going to offer you a bit more money on your dollar. And yeah. That's why I broke it down for you into different dividend stocks. And, that's why I wanted to really get away from that kind of stuff. Just um, just talk about you and me and how we can work together to make you money. Uh, there's other stocks out there. I'm sure you've heard of most of them. But the only thing is that I'm a value investor, and I'm only interested in stuff that's going to turn around and make me money on my money. And we want to get paid monthly so we can retire earlier. That's the whole trick, right? Everybody wants to get out of the rat race, we call it. The only thing is that the rat race turns you into a slave, and majority of us will fall into that suit, unfortunately, because we don't look at different avenues of how to generate income positively. Most of what we see out there is only to make them money. So if you listen to YouTube, you look at all the different categories of YouTube and how affiliation can help you make money. Majority of them are selling you courses on how to make them money. Uh, okay, the Chinese market. Good question, DJ. Awesome. Okay, so Chinese right now um, is not a good investment currently. They just took a big hit on Monday and Tuesday, so right now they're seeing a return on that value, but they are uh, um, still not worth investing into right now. So a little way down the road, they're going to be huge to invest in. Same thing with India. Same thing with the UK. They're just not good investment strategies right now. They are ones to watch really, really closely because um, we're going to see some big, huge drawbacks on the US and China organizations. So, right now, we're going to take an inflationary hit when the when they talk about inflation, because right now they're trying to find ways to fight off inflation, but none of them want to come up with a solution to fight it off. And Joe Biden is not one bit interested in fighting off inflationary concerns. So uh, we got a lot more pain to go through before we start seeing some return on our equity. So right now, China, I would strongly recommend looking at it right now, um, and then try and pick it apart a little bit to find out which areas you want to start investing into. And that's get away from real estate investing. This is strictly those that believe we can make a 20 to 30% return on our equity within a few days. So, um, yeah. So Neo, that's good. A 25% increase. You know what I'm saying, right? We can invest in something that's going to return something very positive very fast, but we're not in that avenue yet. We're not in that stretch yet. We're getting there. This week, next week, and then the third week in March, you should see a significant downturn, and that is when your opportunity comes to buy into Neo and Abitibi. Abitibi, everybody loves Abitibi because it's e-commerce, the same as it does exact same as Amazon, except it's really, really, really cheap to buy Abitibi. The only problem is with them is they're strictly only in Asia, so it takes time for you to get your products. And are they good products when you get them? And they don't have the same rate of return that Amazon does. Amazon looks after their clients, where they have a harder time looking after them because theirs is about like look at them. They took a loss last quarter, um, and they're got under their market share. People that are looking at them are saying that they're still overvalued. So when you say you're overvalued, that means that people are going to be shorting stock, unfortunately. Um, but it's a good time to get in when things get bad. So you can see a 50 to 60% rate of return within a very, very short period of time. So those stocks should be looked at. Same thing with airline stocks. Airline stocks are going to take a hit because oil and gas have gone up. Oil and gas go down a little bit, they come back up just like that. Neo, same thing with Neo. Those are not value stocks; those are plays. Okay, so I'm a value investor. So when you see those, you take it with a grain of salt. And you want to make sure when you're making money on your money that these are your stocks that you play after you've made your money. uh, there's a reason for it, right? Because Bear Stearns didn't start off with going after um, crazy companies. He started off going after real estate companies for a reason. Build your foundation for your longer nest egg, and then you start your plays because then you have the money to play with the market. Don't do it the other way around. You'll find yourself fighting a losing battle, and you could have started off already with one foot, making you money on your money, and then investing it because then you have extra money to play with. So when you're doing those things, when you're playing with money, make sure you have your exit strategies all in sync. Make your plan of action. Get in, get out as soon as you can, uh, so that you don't end up holding a fallen knife. Fallen knife can go right through the hand, right? And it hurts. The further it goes in, the more it hurts. And you thought it hurt when going in. Wait till you pull that son of a gun out. Okay, so um, just be careful when you're investing. Um, and if you want to invest into risk plays, that is on you. Unfortunately, most of it's on you anyway. But that's nor here nor there. And thanks for coming and tuning in. Thanks, DJ. Big thumbs up, buddy. Really appreciate the support. Um, I love everybody. So um, stay tuned. We'll see what we can do. Come up with these videos more frequently. And yeah, we'll keep you informed as much as humanly possible. And I'm looking forward to looking at Neo, and I'm looking forward to Alibaba. Alibaba, I love Alibaba. It's a Chinese franchise. They do it way cheaper than Amazon. They came out with it first before Amazon, and they're behind Amazon. Go figure. Um, but Amazon's all over the world, right? So everybody knows Amazon. Everybody knows Alibaba. Alibaba, like I said, you want to buy a product, you buy it for half the price of it what Amazon's out holding it for. Problem is, Amazon can offer you within a week. Alibaba, 4 months. Well, not quite 4 months, but let's say 6 weeks. Okay, so you're not going to get it right away, and they don't guarantee anything. Okay, you don't get your money back if they don't. The product comes and it's beat up or whatever. They don't guarantee that, and they don't give you your money back. Um, and that's why they're in a mess right now because um, everything is based on customer service. The better customer service you have, the better your product is, the better people like it and can appreciate it. Um, that's why when I'm putting these out there, it's not to make you money, it's to make everybody money, right? Everybody, not just you and me, but everybody money. And the easiest strategy that is available to you so that you can make as much money as possible as soon as possible. So within a short period of time, you're starting to see that rate of return come back to you in huge way. So you don't have to go and stick it into banks and don't have to stick it in ETFs. Don't have to stick it in those fundamental animals and only give you, they promise you 20%, but the fact of the matter is they only give you 5 to 6%. That's because that's all they have to give you to provide you with the information that they gave you in the first place. That's the one trick pony. As soon as you put the money in, 30% of it goes to them. Okay? They make 30% regardless of how much money you make. So that's on ETFs and if you invest through a fund manager. Fund managers will tell you the same thing. Go to all of them, any bank, big bank, TD Waterhouse. You go to any of them, they will not sell you individual stocks. They'll say that's on you. We can sell you ETFs though, no problem, because they go, oh, we can offer you, and they start off 20%. We can make you up to 20% if you pick the right one. Notice they say if, and then they're not liable for any of it. The only thing they're liable for is the ETF that they put you into. And they tell you where you want to put your money. You got 4 categories, 5 categories, 6 categories, 7 categories they can put your money into to make you money. But you pick them. You pick them, they buy them. And that's through the bank managers. They go to TD Waterhouse. Will they tell you to do the exact same thing? They tell you the exact same thing. You want to do investing, you do it on your own. You keep we do offer you platforms to help you, but they're all on you because they want to sell you the ETF. They want to make that 30% commission right off the bat. So that's why they do that. That's why they offer it to you. Uh, Unfortunately, that's just the way it is. It's the one trick pony to everything. So if you want to do the investment yourself, make sure that you buy solid companies. Make sure you have a plan before you buy it. So you want to buy a company, do some research on it. What's their 50-day moving average? What's their 200-day moving average? Um, did they make money last year? How much money did they make last year compared to this year? Uh, and we got through a pandemic, so now all those companies can't lie on their balance books. Now they're going to come up with a strategy to tell you all the stuff that you need to do to make you money as soon as possible. So those strategies now, if they don't make money, they're not going to make money because the market's going to come back, yes, but the business's end of it is going to be really, really slow in how they react to what's going on now. So, like planes, trains, and automobiles, all those are taking a bit of a hit right now because they can't keep up with manufacturing because manufacturing has been shut down for 2 years, and all that real estate that they had invested into is slowly seeking its way out because no one was manufacturing it. Everything was shut down. So now everybody's going back to manufacturing, but there's no product now to send out. Makes sense? So that's why there's a backlog. And now with the EV, like Neil industry, they're dependent on nickel prices staying really low. Their copper prices staying really low. Are copper prices staying low? No. So what's happening is there's an offset in balance. So they have to charge more to make more. Makes sense? So anyway, that was me. It's 52 minutes on the hour, and that is it for me for this session. I hope you enjoyed it. Thanks, DJ, again for your support. I really appreciate that. Anyone coming in and supporting this channel, make sure you subscribe, put a like, send me a comment, so we can keep it going. Like I said, this is free. Um, I don't have a course. I don't offer any courses. I ask you to come in, sit down, chat. We'll do some math. We'll do some research. We'll go through a whole bunch of information that we can help provide each other with so that we can come up with a better strategy to make you money. And that's the bottom line. So thank you for coming and have a great day and a wonderful afternoon, and God bless all of you. Thank you. Bye for now. This was your major investor. Will is your host.